So, Drew, one of the things that we get questions about are qualified plans and how to install one specifically with a cash balance pension plan. I know we get a ton of questions around this and work with a lot of clients on these. Maybe explain to those watching the video how these plans can work for them from a tax advantage perspective.
Yeah, sure. So we do get this question a lot. We have a lot of, business owners that are high income earners that are always looking for ways to potentially reduce taxes, defer taxes, knowing we don't really ever get away from them. We just can move them down the road a little bit. And one of those ways is using cash balance plans, which is, parlayed with a qualified plan, such as most people would know that it's like a 401k. And where you have your elective deferrals, you have company matches that go there. You get up to the max contribution you can from the published IRS rules, but then you can add this additional component to it, which can push you above those limits. So instead of saying it'd be 66,000 as a limit, you can add some of these cash balance plans, defined benefit plans that can push those numbers quite a bit larger. And there's even some unique ways that, to say it lightly, you can kind of put those on steroids, right? Where you can really, if you're having a really big multiple years, that's what's going to be different about these plans is that once you start them, you do have to keep them going. There's going to be some rules that are very specific around them. You can't just really do it for 1 year. The IRS would frown upon that. So you really have to know that, hey, I've had a few years of a good trend. I think I'm going to keep trending. And is there a way that I could maybe put away, $300,000, $400,000, $500,000 into these plans? And the answer to that is the short answer with a lot of nuance to it that we would talk more about in a meeting with a client is, yeah, you potentially could. We would pull in CPAs, there's actuarial calculations that go into that. So there's a lot of nuance to it. But we think we have a lot of clients that, again, referencing some of our other videos, if you've watched those, that we all have this business partner that changes the rules of the game whenever he wants, and it's called the IRS. And so here at Instrumental Wealth, we focus on really trying to help learn those new rule changes, working alongside with CPAs and clients and other tax professionals to, look at a client's unique situation and say, does a cash balance plan, defined benefit plan work with the amount of employees? Because if you want that large deduction, you've really got to step it up in what you do for your employees. So you're going to contribute more to them. So if you're, an employer that says, hey, I'm doing really well, but I don't want to give a big chunk of the IRS if I don't have to, and I'm feeling really good with my employees. They're the reason my company's where it's at. I want to treat them well. And if I can give them a feeling like they're part of the profitability without ownership, I'm open to that conversation. It could make a lot of sense for us to have a dialogue with you around that and with your company. So Dave, I don't know if different conversations you've had with different business owners, if you want to add anything there.
Yeah, absolutely. I thought that was a great overview too, Drew. I mean, I think just to echo one of the comments that you made, which is we never want to let the tax tail wag the dog. To your point, I think so many times people are motivated to avoid paying tax. And even with a cash balance plan, you're not ever going to avoid paying tax. I think that it's one of those things that really it's just a deferment. Now, if done properly, and you're in a tax bracket, let's say today of 37% federally, if designed properly, you can defer paying tax to a year that you're retired, and maybe you've sold the company, and maybe you only need 150, 200 grand a year to live in your retirement years, which puts you in maybe a 12 to 22% marginal rate, and effective rate maybe at 15%. And so I think if anyone said, hey, would you rather pay tax at 37% or 15%? I'm not a math major, but I would take 15% tax than 37. And so that's really where these plans can give a business owner a massive amount of potential tax deduction. Not right for everybody, right? If your business, like I'll tell you who's not a good candidate for these is if you're a real estate developer. where you have wild swings in your cash flow. Bad idea. You need to have consistency with your cash flow. If you have a ton of employees, probably going to be very expensive for you. But generally where these plans work best is if you have a pretty wide disparity between owner and employee as far as the range of their salaries. Their census is pretty small, meaning that there's not a ton of employees that are on the books. Those are where these plans can make sense. And those businesses that generally have as consistent cash flow could be. I mean, I don't care what business you're in, you're never recession proof. And so, but those that have very stable cash flows or predictable cash flows would be very appropriate for this type of plan. But we had a client, perfect example. She is a dentist, spinning off a lot of cash flow. It's her and her partner, and they have a dental hygienist that's a 1099 independent contractor that kind of comes in. They do a lot of not surgeries, but cosmetic type of procedures. So veneers is an example. So a lot of cash versus insurance business. So pretty high margin business as well. And really they have the receptionist. They don't even have someone that bills insurance because they don't take insurance. And these two dentists are bringing in close to about $800,000 per year in total compensation, and they're able to put away several $100,000 away each pre-tax. And I think what it ends up costing them for the few employees that get a contribution is maybe $15,000 or $20,000 of employer contributions to those employees. So that's one example of one that we've installed that pretty consistent business. They don't have a ton of employees on their census where they're taking full advantage of this. But it's not right for everybody, and there's definitely industries that we would tell you, if you're in this industry or look like this, it's always worth a conversation, but likely it's not going to be as advantageous. And so if you've got questions around this, if you're watching this video and you think, hey, I really want to learn more about this, I'd really like to get on Dave or Drew's calendar to discuss if this is a viable option for me, hop on our website at instrumentalwealth.com, schedule time with Drew or myself or one of our other advisors. Message us through social media as well. We'd love to have a deeper conversation to see if this is something that you should explore or not for a potential solution for you.